screen to advance. Let's see. There it goes. All right. So our presenters today are Robert Aliber, Brendan Brown, Robert McCauley, and Gilfie Zoega. I'd like to give a brief introduction to tell you a little bit about Bob Aliber. So Bob was affiliated with the Graduate School of Business of the University of Chicago beginning in 1965, and he became Emeritus Professor of International Econ and Finance in 2004. He's been the Hublon Norman Fellow at the Bank of England, the Bundesbank Professor at the Free University of Berlin, the J.P. Morgan Prize Fellow at the American Academy of Berlin, a visiting scholar at the Woodrow Wilson Center for Scholars in Washington. He's published any number of books. He's written extensively about the prices of currencies, international investment flows, banking issues, the multinational firm, and international monetary arrangements and financial crises. His current research is on the identification of the source of shocks that have led to the large variability in the prices of currencies, bonds, stocks, real estate, and commodities since the 1970s. These shocks have led to more than 40 banking crises, which have been largely overlapping with currency crises. So without further ado, I give you Bob Aliber.
Thank you. Thank you. It's fun to be with Brendan Brown, Bob McCauley, and Gilfie Zoega once again to discuss this ongoing topic, more broadly, international monetary instability. The last 40 years, the last 50 years have been the most unstable in international monetary history, or at least of the last 300 years. And we can measure monetary instability by the frequency and the severity of banking crises. This morning, I will talk briefly about my paper, and we'll then go to Brendan Brown, then to Bob McCauley, and then to Gilfie. So let's begin with my paper. I'm going to first present 4 stylized facts about overshooting in the markets for currencies and in the markets for securities. I'm then going to raise the question about goods market shocks versus money market shocks. That is, if we see large changes in the prices of currencies and assets, is it because of the shocks that have led to these changes have originated in the goods market or in the money market? And that leads to the question, if we had had an alternative currency arrangement, would we have had the similar supply of shocks? And then I'm going to take briefly through 3 country experiences. Each of these countries has experienced a major banking crisis. The first is Iceland, the second is Japan, and the third is the United States. And then in conclusion, I will raise the issue, what is the source of these frequent banking crises? Why have they occurred during a period when we have had a system of flexible exchange rates? So next slide, please. So we've had overshooting in several different markets. We've had overshooting in the market for currencies. But let me suggest that we review the experience of the United States in the first half of the 1980s, when the price of the US dollar increased very significantly. Or we've had overshooting in the market for the Japanese yen, which is very significantly. Virtually every country that has had a banking crisis has experienced an increase in the price of its currency and a boom in its economy in the 3 or 4 years prior to its banking crises. We've also had, at the same time, overshooting in the market for securities. We can think of the market of securities as being the market in stocks or the market and the market in real estate. Now, there's tends to be a large overlap between overshooting in the market for currencies and overshooting in the market for securities. The one exception in my review of the data is that in the 2000 decade, we had overshooting in the US market for real estate, and at a time when the price of the US dollar fell in terms of the currencies of the major US trading partners. Overshooting almost always precedes a banking crisis. Every country that has had a banking crisis has previously had an economic boom, and the price of its currency has tended to increase in real terms and in nominal terms. And the crisis occurs when the inflow of funds that led to the increase in the country's capital account surplus declines. At that time, the markets cannot support the very high price of the country's currency and of its securities. Now, the fourth stylized fact involves why the United States morphed from being the largest creditor country in 1980 to the largest debtor by 1990, and the US net international indebtedness position has increased since then. There have been 4 spikes in the rate of increase of US net international indebtedness, and each of these spikes is associated with an increase in the US capital account surplus, that is, an increase in the foreign demand for US dollar securities. If we could go to the next slide, please. This slide raises the question, did the changes in the US international investment position follow from the changes in the US trade balance? Or instead, did the changes in the trade balance follow from the changes in the US international investment position? That question is, does trade in money drive trade in goods? Or is it the reverse? Is that the trade in goods and imbalances of the goods market drive the changes in international capital flows? We could go to the next slide, please. So let me come now to the Iceland experience. Iceland, some of you know, is my favorite small country. Iceland experienced an autonomous increase in its capital account surplus beginning about the year 2001, 2002. But Iceland could only have experienced an increase in its capital account surplus if at the same time there was a corresponding increase in its current account deficits. 2 factors contributed to the increase in Iceland's current account deficit. One was the increase in the price of the Icelandic krona, and the second was the increase in the price of Icelandic stocks. The increase in the price of Icelandic stocks led to a massive economic boom. That economic boom featured a surge in consumption spending, and the surge in consumption spending led to an increase in spending, in additional spending on both domestic goods and services and foreign goods and services. Now, the increase in Iceland's external indebtedness was substantially higher or more rapid than the increase in its GNP and then the interest rate. And so almost from the very beginning, one could observe that the increase in Iceland's external indebtedness was too rapid to be sustained. When the foreign demand for Icelandic securities slowed, and that occurred in the year 2008, the price of the krona fell and the price of krona securities fell, and the decline in the price of both the krona and the decline in the price of krona securities led to the bankruptcy of the Icelandic banking system. So the overshooting in the market for the currency and in the market for stocks was too large to be sustained. If we could go now to the next slide, please. Now, the Japanese experience differs significantly from the Icelandic experience in that Japan had a capital account deficit. Iceland had a capital account surplus, or if you look at the mirrors, Japan had a current account surplus and Iceland had a current account deficit. Japan's capital account deficit in the mid-1980s was 5% of its GDP, or a higher value than the rate of growth of its GDP. In the second half of the 1980s, Japan's capital account deficit declined to 2% of its GDP. Now, the conventional analysis is that the surge in asset prices in Japan in the second half of the 1980s could be attributed to the very rapid monetary expansion. The problem with this explanation, the conventional explanation, is that if Japan experienced a very rapid increase in its money supply growth, that should have led to a goods market inflation. That did not happen. That should have led to a decline in the price of the Japanese yen. It did not happen. Instead, the driver of the change in the values in Japan in the second half of the 1980s was the increase in the demand for yen securities, which led to a decline in its capital account deficit. But Japan could experience a decline in its capital account deficit only if at the same time there was a comparable decline in its current account surplus. Two factors contributed to the decline in that surplus. One was the increase in the price of the yen. And the second, and more important or powerful, was the increase in the price of Japanese stocks. By the end of 1989, Japan's capital account deficit had declined to 2% of its GDP. There was no further need for a decline in Japan's capital account deficit, and hence there was no further need for an increase in Japanese asset prices. And when Japanese asset prices stopped increasing, they immediately declined because they had been sustained by the momentum of the previous increase and not by the underlying asset values. If we come now to the US, the next slide, please. So we can use the same model to understand the US experience. There have been 4 spikes in the prices of US assets, one in each decade. There have been 3 spikes in the price of the US dollar. The exception is that in the 2000 decade, the price of the US dollar did not spike because the prices of the British pound, the Icelandic krona, and the euro increased by a larger amount. There has been one massive bank price I see I've left the word up, collapse, and that it was in from 2006 to 2010. And during this period, the United States evolved from the world's largest creditor to the world's largest debtor, not because it was the shortage of US savings. All of the initiative that led to a change in the US international investment position occurred in other countries. The common explanation, of course, is that there is a shortage of US savings. But every one of these spikes in US asset prices has been associated with a consumption boom. And the consumption boom reflects that the inflow of foreign savings has displaced US savings. If we come now to the next spike, sorry, to the next overhead, please. Now, what I've done is to summarize why the data on why the case for flexible exchange rates is intellectually bankrupt. And that's because of the inconsistency between its one of its major claims of central bank monetary independence. If we have a world of flexible exchange rates, and then we'll end up with a much greater incentives for investors to buy foreign securities. That will lead to increases in the prices of foreign currencies and to increases in the prices of foreign securities. The increase in the price of foreign securities and currencies will be too rapid to be sustained. And when the capital flows diminish, the banking crises will occur. Thank you very much. I'm finished.
Right, so you're going to introduce Brendan?
Oh, yes. Our next speaker is Brendan Brown, one of my students of 10 or 20 years ago. Got his MBA at Chicago and his PhD from the London School of Economics. Please, Brendan.
Thank you, Bob, for your introduction, and apologies also for the audience for multiple changes in the heading to my talk today. But as shown here, it's now US dollar hegemon century without a solid anchor, options for redesign. And in my slide 2, I'm very much indebted to Bob Alibert for an insight he provided many decades ago when talking about monetary regimes over the last century and likening this to French republics. Well, we're now in the 5th French Republic, but according to my totting up of monetary regimes for the US monetary hegemon, we're probably at the 6th regime and possibly going on to a 7th. So what I do in this slide is summarize the monetary anchor regimes we've had since the US dollar became the hegemon in 1919. First of all, the US unilateral gold standard of 1919 to 33, during which the US, although it was on gold, retained considerable discretion as regards its monetary policy. Then we had the truncated dollar-gold convertibility for foreigners from 1936 to 1968 or 71, according to where you take the end of the gold convertibility for foreigners as. Then we had a period of embryonic money supply targets from 72 to 79, followed by the monetarist experiment associated with Paul Volcker of 1979 to 84. Then the abandonment of that experiment and a period of anchorless monetary policy with ornamental money supply targets from 1985 to 1996. And then the present period, which I would describe as anchorless under the 2% inflation standard from 1997. But I think you're due now an explanation as to what I mean here by the term monetary anchor, which I hope to provide in the next slide. So concept, what we mean by monetary anchoring. I think the best way to approach the topic of monetary anchor is to consider this as a device which constrains the growth in the supply of money, such that it doesn't veer ahead on a persistent basis or veer below on a persistent basis for demand for money. And if you have no anchor or no solid anchor, and these periods of varying money supply ahead of demand or below demand occur, then you end up with serious monetary inflation or deflation. And here I come on to the glossary of other terms, which again, I don't want to over elaborate in a short talk. But monetary inflation, I think the best way to consider this is thinking about Milton Friedman's essay on the inflation gap, published way back in 1944, in which he likens the inflation gap to the mirage on a hot day in the road, that the inflation gap is always out there in the future, but it's never there when you actually get to the spot where you see it. Because what actually happens is that when money supply is veering ahead of money demand, prices of course rise, or other adjustments take place, which mean that the demand for money in nominal terms is pushed up to equate the risen supply of money. But of course, by the time that happens, the central bank or whatever it is injecting even more money into the system usually, so that yet again, when you look into the future, the mirage is back and the inflation gap is back. So that's the essence of the monetary inflation process. And the monetary inflation process shows up in either goods markets or asset markets, as I've highlighted in many previous talks. There's no highly reliable way necessarily in judging when goods inflation is here at an early point, because there can be various aspects of natural rhythm of prices which disguise the onset of goods inflation, as we will see as when I come on to discuss the pandemic. In asset markets, the inflationary process is very much rooted in distortion of prices away from full information rationality by the processes which the monetary inflation generate. A solid anchor is one which prevents the monetary system going seriously into a monetary inflation. An unsolid anchor is one which doesn't succeed in that purpose. And I come on finally to the concept of super money, which I'm going to come back to quite a lot in this talk, because as I explained at the beginning, the definition of monetary inflation, depending on money, recognizing when money supply is veering ahead of demand, does depend on there being a stable and strong and broad demand for money. And my contention here in the paper which backs this talk is that for that to be the case, there has to be some core assets in the monetary system for which there is which have super money qualities, which means that there's a very strong and broad and stable demand for those particular assets, which means that there is sense and empirical validity in talking about money supply veering ahead of money demand. And this comes on to my next slide. Failed anchor redesigns. The monetarist experiment, which we associate with the years 1979 to 83, were an attempt to anchor the US monetary system based on having strict targets for base money growth on the assumption that there was a fairly stable and strong and broad demand for high-powered monetary base. It's not surprising, given that first attempt and only attempt or only experiment to provide the dollar with a solid anchor, that the dollar rose very, very strongly in foreign exchange markets to reflect the attractiveness of such an asset, such a money as the US, as a hard US dollar. But of course, that rise in the dollar's international exchange value did produce various problems, which in the literature we would associate with the anchoring problem. When you suddenly anchor a currency which has been unanchored for so long, there's bound to be frictions and rearrangements of relative prices which hurt particular sectors of the economy. And by the time we get to 1984, 1985, with the US verging on a recession or growth recession, and the Reagan administration facing a difficult midterm election in '86, and James Baker, highly political Treasury Secretary. We all know that ended with the 1985 Plaza Accord and the Volcker Fed going into a period of abandoning the monetarist experiment in favor of dollar devaluation at Plaza and the monetary policy to go along with that. So essentially the monetarist experiment broke down. The attempt to provide a solid anchor to the dollar was abandoned. Also abandoned had been any talk of a gold reform, and after in the twilight years of the Carter administration, there was a bill signed into law, the so-called Gold Commission law, in which there was going to be a study of a new role for gold in the US monetary system. But by the time the Reagan administration fills this commission up with mostly anti-gold economists, that really came to nowhere. So we have the monetarism abandoned, new emergence of monetary inflation in the anchorless US dollar through 1986 to 1990, which showed up, of course, in the great asset inflation and also a new run-up of US goods inflation, which by the end of the 1980s was back up to 5–6% again. And then we go on to the inflation standard reform of 1996, where the idea is to anchor or to stabilize the US monetary system by adopting a 2% inflation standard. But of course, this 2% inflation standard is a totally anchored system because there's no targeting of money supply. There's no pretense that the system has been designed in any way such as to foster a strong and stable and broad demand for monetary base. And so this inflation standard depends ultimately on the cleverness of the central bank to use its econometric modeling to such as to be able to steer short-term interest rates in a way, together with periodic adjustments, big adjustments in the size of its balance sheet, to achieve a given inflation target, which is set at 2%. But all of this is black box stuff, depending on a whole lot of highly questionable econometric type assumptions and rules, including labor market variations, which really, well, at the time, it seemed to enjoy a certain amount of credibility for the talk in the late 90s and early part of the century about the new age of moderation. But of course, all of that blew up. And I note here 4 failures of the inflation standard. First of all, the great asset inflation of 1996 to 2007, blowing up in the great financial crisis, which I date as 2008 to 2012, including the European dimension, which went on a lot longer than the US dimension. Then we have the great economic sclerosis coupled with continued asset inflation of the 2013-20 period. And then we come on to what's happened in the last 2 years, the great pandemic inflation. And if anyone was in any doubt about the 2% inflation standard in the US providing any sort of anchoring for the US monetary system, they must now have lost that confidence. With 8% inflation in 2021, despite a Fed which thought it was had everything positioned in terms of its interest rate targeting and central bank management to achieve 2% target inflation. So we can now characterize the situation as essentially where the 2% inflation standard must finally, or seems to have collapsed, although that collapse is most obvious in the case of the US and perhaps least obvious in the case of Switzerland and Japan. Now, this comes on to my final topic. So what are we going to do about what's the prospect for redesigning or hoping to get back, not back because we've never had it under US hegemon, but what's the prospects of this collapse of a 2% inflation standard leading on to any solid anchoring of the US monetary system. And I don't pretend to have all the answers here for a short session, but what I look at here is a few bullet points. But if we are to consider anchoring solidly the US monetary system, we have to get back to the idea of this being based on a device which constrains the supply of money. Now that constraint on the supply of money isn't in some rigid form, such as you may have for Bitcoin, where the supply of money is fixed forevermore. It has to be a supple supply of money constraint where this does move around over time up in line with real demand for money. Secondly, there has to be a strong and stable and broad demand for base money. Now, you don't just get that by immaculate conception. To produce a strong and stable and broad demand for US based money, there has to be a lot of thought given to how this condition is created. And what I suggest here is that the answer or the way forward on this is in fact competition in every sense. That if you're to have money which is very money-like and for which there's a strong and stable demand, it means that money in its base money form has to be unique and very different from any other asset. So it has to perform the functions of money much more strongly than any alternative assets. And when you think about the one big element in base money, which is money reserves, banks' reserves at the Fed under the fiat money dollar system, that's very difficult to create unless you do a lot to pare back lender of last resort, deposit insurance, too big to fail, all the things which in fact means that banks don't see any special property in holding reserves at all, other than if they have to hold them, or in the present system where banks, of course, are very happy to hold a lot of reserves because they pay an above market rate of interest. And when you think of other elements of base money, I would suggest that allowing competition in the form of banks being able to issue banknotes of any denomination, including much larger than what we have at the present, and banks being able to issue stable coins, again in dollar denomination, for which there could be very broad demand. These are the sort of reforms we need to think about in terms of creating a demand for money such as would allow a solid anchoring to take place. I'm very happy in the question and answer session to consider other forms of anchoring, including commodity-based anchors, gold-based anchors, or other type of real-based anchors. But at this stage, I leave you with these thoughts and look forward to continuing them in the question session.
Thank you, Brendan. Our next speaker is Bob McCauley. When I first met Bob 30 or 40 years ago, he was then with the Federal Reserve Bank of New York. And then he moved and spent much of his career with the Bank for International Settlements, both in Basel, and for some time he was head of the Hong Kong office for the Bank of International Settlements. Bob, please.
Thank you, Bob. My theme today is the Fed is the global dollar lender of last resort. The Russian sanctions recently have highlighted the power that comes with the dollar as the operating system of global finance. My presentation focuses on responsibility that comes with leadership or hegemony that comes with the dollar role. And my presumption is that the leader cannot withdraw dollar funding from the rest of the world when things get tough. Yet that is precisely the propensity of US financial markets. My thesis is that the Fed's last resort lending and buying has sustained or stabilized dollar credit globally and preserved US leadership. Next slide. So the Fed is a backstop for the global domain for the dollar. How has it done it? Well, we'll look at two occasions, 2008, 2020. And in 2008, the Fed backstopped the global dollar with a domestic device of discount window lending that went heavily to non-US banks. And it also served as a buyer and underwriter of last resort of the assets held by US money market funds, which in turn were the biggest funders of non-US banks. So the Fed stopped a run on the dollar funding of non-US banks by bolstering the money market funds. And finally, most clearly internationally, by the Fed swapped dollars with central banks that in turn provided dollar funding offshore to non-US banks. So in 2020 and compressed in March of 2020, we saw again the Fed stabilize money market funds and thereby the dollar funding of non-US banks. Again, we saw the Fed roll out the dollar credit through central bank swap lines. But in addition, we saw two big interventions in the bond market, not just the money market. The Fed bought treasuries, among others, from foreign central banks, and the Fed promised to buy US corporate bonds, but in the process, it managed to stabilize the market for dollar bonds issued by non-US residents, governments, and firms. Next slide, please. A quick overview of the dollar system, the global dollar domain. On the left side, you see borrowing by non-banks outside the United States. Bank loans at the bottom in red and blue bonds issued by these non-banks. We're looking these days at about $13 trillion worth of borrowing dollars by non-US residents. And on the right side, we have a like amount that is borrowed by non-US banks. And not pictured is still another big aggregate of credit, which is taken on in the foreign exchange market, in the so-called foreign exchange swap market, where in effect, dollars are borrowed against other currencies. And there we're looking at 10, 20 trillion dollars worth of debt, much of it used to hedge holdings of US bonds and stocks. So these are the aggregates that no one intended really that exist and that the Fed has had to contend with at moments of strain. Next slide, please. So going back to 2008, we had the the basic problem was that non-US banks had loaded up on exposure to US housing. And as private mortgage-backed securities declined in value, they were suffering runs. So in December 2007, the Fed rolls out a retooled discount window called the term auction facility that basically had no stigma, and non-US banks were the major users of this credit. Although it was a domestic lender of last resort operation, it was the non-US banks, non-US headquartered banks in the United States that were the big drawers. But it was supplemented. It was sort of a discount window plus because there were parallel operations done by the European Central Bank and the Swiss National Bank, so with the ECB serving sort of as a 13th Federal Reserve district. But most of the action was in New York at the discount window, and the amounts coming from the swap lines with the ECB and Swiss National Bank were on the small side. Next slide, please. So that was the story before Lehman. As soon as Lehman defaulted, it became evident just how fragile the funding was of the non-US banks. They depended very heavily on money market funds, and suddenly there was a run on money market funds because one of them could not repay the shares at par. And in response, the Federal Reserve and the Treasury basically came to the aid of the money market funds. The Fed, in effect, bought asset-backed commercial paper as a sort of buyer of last resort. The Fed underwrote commercial paper, so it was an underwriter of last resort, and the US Treasury came in as a guarantor of the par value of money market funds. So all of these policies managed to stop the run on money market funds and therefore stop the sort of secondary run on non-US banks, but not before $175 billion plus had been lost in the way of funding by non-US banks. So again, a domestic last resort operation, but with a very important implication for non-US banks, global dollar funding. Next slide, please. And the final big step in 2008 were the Fed swaps to central banks. As noted, they started already in December 2007, but after Lehman, the need of non-US banks for dollars was so big that the number of central banks involved was widened. The amounts were enlarged, the term was lengthened, and in mid-October 2008, the unimaginable step was taken of basically no ex-ante limits on how much could be taken down by non-US banks from the central bank partners that could get money, dollars freshly minted, as it were, from the Fed. And the total amounts went to a very large number, almost $600 billion. So this was the clear international lender of last resort. The other two policies, the discount window, the money market fund support, were domestic lender of last resort with major implications for the funding of non-US banks. So with that, we move forward to 2020. In the next slide, please. Oh, this is what a swap looks like. The Fed sends, in the top line, sends dollars across to partner central bank, which on lends to commercial banks against collateral, and the interest flows in the other direction. Next slide, please. The overall picture that you should have in mind, look at the top line. We start a situation where US investors put money in risky US money market funds that put money into European banks. There's a run on the money market funds that provide that sort of funding to your banks. And we go to the bottom line with the New York Fed lending money to banks. Next slide, please. Next slide, please. Thank you. So in 2020, the Fed backstops the dollar, money, and bond market. So again, the Fed faced runs on money market funds. Again, The Fed stabilized the money market funds. Again, it extended credit to non-US banks through central bank swap lines. Again, but differently this time, it responded to disruptions in the bond market by buying US treasuries from foreign central banks and by stabilizing the market for dollar bonds issued by non-US borrowers. Next slide, please. So again, there was a run on money market funds, even though none broke the buck in March of 2020. And again, the Fed became the underwriter of last resort and the buyer of last resort of commercial paper, which brought the run to the end, an end to the run. However, still the money market funds lost a fair amount of deposits or quasi-deposits, and consequently non-US banks lost a considerable amount of funding. Next slide. So again, the Fed extends the swap lines. This time it was in very much a fast forward within the space of a month, doing what had taken, within the space of weeks really, doing what it took months to do back in 2008. The widening of the number of central banks, the lengthening of the operations, the reduction of the spreads, and again, 14 central banks ultimately involved. So the amounts went out very, very quickly. Next slide, please. In the space of just weeks in March, we got up to 400 billion outstanding. We ended up to the end of April at less than 500 billion. Slide, please. Now, it may sound like 14 central banks is a very narrow circle for the Fed to be operating with, but if you look at which currencies account for the bulk of trading in foreign exchange swaps, in which, as I say, tens of trillions of dollars are borrowed outstanding at any moment. What you see is that the big four, the ECB, the Bank of Japan, the Big Five, the Bank of England, the Swiss National Bank, Canadian Central Bank, Bank of Canada, that they account for 2/3, their currencies account for 2/3 of the swap trading, and the other central banks involved account for another 6, so that fully 85% of all the private dealing in foreign exchange swaps is accounted for by the central bank partners that the Fed has taken on. Next slide, please. And again, what was new in 2020 was the disruption in the bond market, and selling in the treasury market was coming from all sides, from hedge funds that got caught off sides by investors in US bond funds that sold almost 6% of their holdings in March. Lots of treasuries got sold by the funds in order to raise the money to return to the investors, and central banks abroad sold $200 billion in order to hold liquid balances at an uncertain time in March of 2020. But the Fed stepped in and bought almost $1 trillion worth of treasury bonds in the space of weeks. The operating instruction in the amounts needed to restore proper functioning of the market. So inter alia, the Fed bought bonds back from foreign central banks and ultimately introduced a repo facility so that foreign central banks could raise cash against treasuries at any time. Next slide, please. So this is a key and I think generally overlooked point. The Federal Reserve came in extraordinarily in the course of March with a promise to buy US corporate bonds. And it eventually extended the promise from investment grade bonds to junk bonds. It never promised to or bought bonds issued in mass by the rest of the world, which that early slide shows to be
Okay, thank you.
7 trillion. So in outstanding, but when the Fed promised to buy the US corporate bonds, it had an effect on the bonds issued by the rest of the world in dollars. And what happened in particular was that as the Fed undertook to buy US corporate bonds, it raised prices and turned around bond flows into these dollar bonds issued by the rest of the world. So the unintended result was that the Fed's last resort buying of US corporates also raised prices and turned around flows into dollar bonds issued by non-US borrowers. Next slide, please. Next slide, please. Thank you. So here are prices of exchange traded funds. The blue is for investment grade bonds. The yellow is for US junk bonds, and the black is for emerging market dollar bonds. And the emerging market and the investment grade bonds basically bottomed out in price just as the Fed started to lend to the big securities dealers, the so-called primary dealers. But then all of these bonds jumped in price when the Fed promised to buy US corporate bonds, initially just investment grade, and again rose in value when the Fed undertook to buy US junk bonds. And so what you see here is that although the Fed's buying was focused on the bonds represented by the blue and yellow lines, the bonds from the rest of the world, the emerging market bonds in black, responded in much the same fashion, so that the Fed, by undertaking to buy US bonds, again, a domestic operation, actually had a much broader effect than intended and raised the prices, as I would read this graph, raised the prices of the dollar bonds issued in the rest of the world. Next slide, please. And what you see with the prices, you also see with the flows that they bottomed out in blue with investment grade bonds in the week that the Fed promised to buy investment grade bonds, and even sooner for the emerging market bonds and for the junk bonds. And again, the flows of US investors into mutual funds holding the global bonds in gray resembles very much the flows into US corporate bonds. So again, the upshot is a purely domestically focused instrument, namely buying US corporate bonds, had the broader effect of stabilizing the market for dollar bonds issued by the rest of the world. Again, some $6-7 trillion worth. Next slide, please. So to conclude, my thesis is that the Fed's last resort operations are maintaining US global economic leadership, that the global economic leader has to at least maintain its lending to the rest of the world during an economic downturn. That's Kindleberger. Yet left to themselves, it's very, very clear that US financial markets tend to cut and run, tend to cut credit to the rest of the world, as in 2008, 2020, when times get tough. But it's the Fed's lending and buying of last resort in 2008 and 2020 that have both replaced private credit to the rest of the world and checked the withdrawal of private credit to the rest of the world. So the upshot is that US global economic leadership has come to depend on the Fed's backstopping of global dollar banking and global dollar bond markets. Thank you.
Thank you very much, Bob. Very informative. Encyclopedic in a way. Our next speaker is Gilfy Zwega. who is a professor both at the University of Iceland and in Birkbeck College, London. Gylfi, please.
Yes, thank you. So this presentation is inspired by Bob Oliver's work. I remember I met Bob for the first time. Can you all hear me? You can hear me?
Yeah, sorry, we're muted, so.
Okay. Yeah, so I met Bob first here in 2007. He was visiting Iceland and sitting in the sofa here next to my desk. And he said, I remember he said, I've seen this pattern before, this pattern of capital flows and current account deficits. And he just gave us a brief talk on this relationship between capital flows and current account deficits. So what I wanted to do here is to look for patterns in the data to see, because if it's capital flows that are causing current account deficits, then we would see a pattern across countries. It wouldn't just be one or a random selection of countries that develop deficits or surpluses. So I wanted to just look at the data and see if we can find patterns. And if we go to the next slide, can you go to the next slide? So I have data on current account surpluses and deficits for the OECD countries and some emerging markets. And I use that, on we go. I use that to try to discover, can you move on, patterns in the data using pure statistics without imposing any view of the world on the data. There are no regressions. We just look at the data and see what the data tell us. So this is data for 47 countries going back to 1995. I would like to go further back, but after 1990, we get an increase in the number of countries with Eastern Europe becoming capitalist, China becoming capitalist, Russia being sort of part of the world, the Western world, well, the world we're studying here. And so I started in 95. I could do this further back with the smaller selection of countries. And on we go. We have, can you click enter? Someone should be clicking enter.
Yeah, that's what I'm doing, but. All right, maybe I'll try something else. It seems to be hung up. There it goes.
And so these principal components, you can think of them as variables that one simple way of thinking of them is that they're each is a weighted average of the country series. So if we have for each of the 47 countries data on current account surpluses from 95 to 2020, and there are 47 countries, so it's very difficult to see the pattern by just looking at the data. So we construct these variables, each of which you can think of as a weighted average of the country variables, and then try to understand if we can define them, if they make sense, and then see how much they can explain of the data. And these constructed variables may measure some underlying factors like Bob Oliver's capital flows, how that it can explain how the pattern of surpluses and deficits evolved across countries and over time. And then we click. So the analysis identifies the origins of surplus savings, which triggered capital inflows into different currencies. And if you click again, so that the results will show the patterns, the overall patterns over this period across these 47 countries. And let's go on. And this is the data. So you see here, there's a matrix. So it has these 26 years and 47 countries. So there's from Argentina, Argentina to the left from 1995 to 2020. And then you move on, it's China and Colombia and Costa Rica and Japan and Russia and so forth, ending with the US. And when you look at this matrix, it's very difficult to see any patterns. But what the statistics do is they summarize the information in the matrix by constructing these principal components. So if we move on, so what happens when I do this analysis is that the most important principal component captures 38% of the variation in the matrix. It explains 38%. The second one explains 22%. So I can construct two variables that explains together, they explain 60% of the variation in the data. The third explains less, 9%, and we're up to close to 70%. So we've compressed 47 variables into 3, and that should capture 70% of the variation in the data. So then if we move on to the next one, so then these are the eigenvectors. Now, you don't need to go into the details of this, but you try to find patterns. Like here, the PC1 is the first principal component, and I've highlighted the positive values. So to try to find patterns, and then what's not highlighted are negative numbers. And so I go from Australia to Italy in the first column, then it continues in the column to the right from Japan to the US. So these are the OECD countries. Then I have some emerging countries in the last few columns. So I do this for each of these principal components. And then if we move on, this is the first component. So it's sort of an artificial, it's a generated variable that I can, by looking at the previous slide, understand as capturing the story that Bob Oliver was just telling about capital flows into Iceland and into the US in the first decade of the century. So that the capital inflow into the US and also other countries, the Baltics, Greece, Spain, they're not all floating countries. There are some Euro countries, Italy, Greece, Spain, Portugal, and then the reversal after 2008. So you can think of the current account surplus as becoming increasingly negative and then positive after the financial crisis. So this, you see, it goes down, and then after 2008, it goes up. So that's sort of a common pattern. And this one variable explains close to 40% of the variation in the data. So this one occurrence, the current account deficits and capital account surpluses of these countries, and that they moved in this way. So the capital account became positive, the current account became increasingly negative until 2008. And after the crash of 2008, it's all reversed. Suddenly, these countries were current account deficit countries become current account surplus countries. So this one variable explains a significant fraction of the variation in that huge matrix that we saw in the beginning. The next one, so we go to the next slide, explains 22% of the variation. And what this variable seems to capture is the separation between chronic surplus countries and more chronic deficit countries, so the current account deficit countries. So we have this variable gives a high weight, positive weight to Germany, the Netherlands, Austria, Denmark, Norway, Sweden, China, Saudi Arabia. So these are surplus countries, current account surplus countries, and a negative value to UK, US, Ireland, New Zealand, Turkey, Belgium, France, Italy. So it's so it seems to be this separation between the two groups, and that the surpluses became bigger after 2002, 3, 4, and then have remained high. So this is sort of the imbalance you can think of the imbalance between surplus and deficit countries. Now I have 2 more minutes.
You've got
Okay,
plenty of
now
time.
We move on to the next. And the third one, I think I can, it gets increasingly difficult to define these components as we get into from the first two. The third one, it seems that it's a capital inflow variable into emerging markets, but not just emerging markets. There are some others there also, so that so this is a capital inflow that has continued. So it did not have a sudden stop in 2008, but continued. So there have been deficits since 2008. Now, the last component, which is on the next slide, I could not, maybe you have ideas about this. We can talk about it later. But that's a component that, wasn't there one before this? Yeah, the fourth one has a big jump in current account surpluses around the turn of the century. So I thought this might be a commodity price boom. It has, yeah, I think we got mixed up here. This is the Russia, now it makes sense. Russia, Norway, Colombia, New Zealand, Indonesia. There's a big jump in the current account surplus around 2000, and then it gradually comes down. I couldn't quite figure out what this was, but can you back one slide? Because I think we skipped that. Yeah, this is the emerging market boom. So it's the capital inflows into emerging markets started before 2008, continued after the crisis. So we have Argentina, Brazil, India, Indonesia, South Africa. I think it explains 9%, only 9% of the variation in the data. And then if we go on to the next slide, that's the one I find difficult to understand, the sudden spike in the current account surplus around 2000. Well, for Russia, I guess it was a capital outflow around the turn of the century that may have helped with the current account surplus, but it's not just Russia. Russia is strong in this variable, but there's other countries too. So what I found then in this complex matrix, 47 countries over these 26 years, that see three variables. One with the Oliver story about capital inflows into a group of countries. So it's Iceland, the US, and it's Greece, and it's Italy, Spain, and so forth. And then a sudden stop and a reversal. That explains most of the variation. Then there's a chronic separation between surplus and deficit countries in Northern Europe and Southern Europe and so forth. That's the second one. The third one is a capital flow into emerging markets. Fourth one, I don't know what it is. So that the concluding remarks then are that we have the three underlying factors that explain close to 70% of the variation in the current account of 47 countries from 95 to 2000. So they are the Western financial crisis, the boom and bust with a capital inflow into a group of countries. Yes, Italy, Greece, Spain, Portugal, Baltic, Estonia, Lithuania, Latvia, Iceland, and then a sudden stop. This is 38% of the variation in the matrix. And then we have the difference between surplus and deficit countries, chronic surplus and deficit countries. And then we have the emerging market countries, capital inflow that continues after 2008. So the bottom line is that these waves seem to form a pattern which is consistent with Bob's theory, I think. That is not the pattern of surpluses and deficits is not it's not random. There seems to be, one could explain the pattern with these capital movements that we've been talking about here today. Yeah. Okay, so that's it.
Hey,
I
thank
think I'm on time, right?
Yes.
Perfect on time. raise your average on keeping on time. And
Yeah,
we'll
last-
discard the
Last-
earlier. So we might want to do at this stage is discussion among the four of us. And then at some stage, if there are others who've been listening and have questions, let's hope that they will ask questions to us at this time. So Brendan, you have questions for Bob or Gilfie or me, and then Bob Macaulay, etc.
I have one or two questions noted down here, and maybe I could start with you. If you were extending your critique of floating exchange rates and the instability of capital flows to this period of a pandemic to 2020, 2022, would you make any observations about that? I mean, where you think the parallel may be this time around?
I don't, but one of the issues I want to raise for Bob Macaulay is the similarity between 2010 crisis and what happened with the pandemic in those several months of April. And as Bob was talking, I kept thinking, what would Badgett have been asking? What would Badgett have been asking about the analogy between the situations, between the run-ups before we had the sudden, very sharp downward shocks? Brendan, was there anything?
If I could add another question in there for Bob Macaulay, it would be just going one stage further back. Why do we need this lender of last resort? I'm sorry to ask such a silly question, but maybe we should go with that one step further back. And if we pulled this proper way, what could we have instead?
Should I take the floor,
Bob
Bob?
Macaulay?
Yes. Let me take Brendan's question first. I would say that the lender of last resort, I'm not sure whether you're asking in the general case or the international case. Let me take the international case. The lender of last resort, given the domain of the dollar, there's a problem that non-US banks have taken on vast liabilities, $13 trillion on balance sheet. And only about 20% of that is in the United States, where their affiliates would have access to the Federal Reserve discount window. So 80% of the liabilities of non-US banks in dollars are offshore and do not have any access to a dollar lender under normal circumstances. And I suppose in the domestic context, we found it inconvenient to have a large, ultimately destabilizing to have a large chunk of the banking system without access to a lender of last resort. Yet that's what we have in the dollar system. A very large chunk of the dollar liabilities in the world do not have access to a discount window. So the devices that I described, ranging from domestic instruments with international implications to the international instrument of the swap line between central banks, these are workarounds given that basic problem.
I mean, if I could go one stage further back there and just ask if we had a much more restricted lender of last resort function internationally as domestically, probably much more in line with what Badgett had in mind than anything seen in the last 20 or 30 years, wouldn't banks have been behaving in a very different way anyhow? I mean, in a way, you've got the moral hazard issue here that because banks know there's some sort of lender of last resort in a terrific scale it's operating, they position themselves in a very different way than what they would have done than if it was quite clear there wasn't that lender of last resort function there.
That's a perennial argument, of course, and I guess my sense is that no one anticipated the Federal Reserve going for unlimited swaps. So what actually occurred in 2008 was not something that private bankers had contemplated and gamed and gotten themselves in front of. It's something I think was for professionals sort of unimagined. And so I find it extremely unlikely that the behavior of the bankers is to be explained by their anticipation of something that you find no discussion of in the professional literature. Let me take a stab at Bob's question, which was the similarities, differences, 2008, 2020. They're very different cases because we had runs on banks in 2008. The biggest banks in the world, some of the biggest banks in the world, many of the biggest banks in the world suffered very, very serious runs in 2008. That did not happen in 2020. To the extent that banks suddenly needed liquidity in 2020, it was because companies were desiring liquidity and drew down credit lines with banks. So banks were scrambling in a certain sense, but it wasn't because their depositors had lost confidence in their safety and soundness. And whereas in 2008, there was a sort of flight to quality into treasury securities, especially treasury bills, by the rest of the world, not least foreign central banks. We had the opposite in 2020 with both private and public portfolio managers trying to get out of treasuries and dumping them into a market that showed unbelievable volatility and fragility. So the extent to which the bond market was unstable was completely different in the two cases. And what I take to be an incipient run on the bond mutual funds in the United States, that had no parallel in 2008. In 2020, we had a very, very large redemption of mutual fund shares and bond funds by US investors. And if that had been allowed to run on, and here you might really ask what Bagehot would have said about the Fed coming in as a buyer of last resort for corporate bonds. That's really quite distant from anything that Bagehot ever witnessed, much less blessed. Nevertheless, without the Fed putting out a bid, it wasn't a large bid, but it was an efficacious bid, as the graphs I presented suggest. Without the Fed putting out a bid, that could have gone very far. There could have been a downward spiral of redemption and prices in bonds with some credit risk in them. And there's really no telling where that might have ended. So the Fed, by promising to buy not very many bonds and mostly accomplishing its ends before it bought any bonds, did turn around what could have been a very vicious circle in my view.
So can I try a different play on that same comparison? That in 2008, of the 2005-2010 period about the solvency of some institutions and the assets shifts or the flight to quality was away from those institutions, in part the money market funds. I'm trying to develop the analogy. There was an asset, there was a portfolio shift as well in 2020, a very sudden portfolio shift, but without the initial, without what the intuitive sense that certain institutions might have been on the verge of bankruptcy. But what I don't fully understand is the nature of that portfolio shift in 2020 compared with the earlier portfolio shift. I think Badger would have been flummoxed by the portfolio shift in 2020. And what makes that so unique is that after 2 months, it was more or less reversed.
I would say not on its own. I mean, we have the Fed acting in multiple dimensions at a speed unlike anything we've ever seen, including the purchase of the Treasury bonds, 900 billion in 3 weeks. That's a lot every day, a lot every hour, a lot every minute. But I think you're right. I mean, the run, a 19th century run, was an external drain into gold out of sterling bills, or a drain to cash within the country. These were the sort of things that Bagehot was used to, from sterling into gold, or from bank deposits or bills into cash. And 2020 was very different from that. It was out of bonds into bank deposits. I think it's something we've never seen before, and flummox is probably not a bad verb for it.
So we would say for out of bonds into bank deposits, essentially the owners of these securities were shortening their maturities. They were, was it a credit risk problem or a maturity risk problem?
I think some of the hedge funds were just caught off base. They were long cash treasuries and short futures. So they were just kind of caught off base, picking up nickels in front of the bulldozer. But the people selling bond funds, I think, had thought of them as being kind of like deposits, only with higher interest rates, pretty safe place to put their money. And all of a sudden the prices were moving all around. And the foreign central banks, I think, just anticipated that they might need cash, and were doing what they could get to get into it. So I think no one was leaving Treasury securities because she thought they were suddenly unsafe from a credit standpoint. So I think it was if there was a run from something, it was a run from the duration, a run from the price instability that was evident in the pricing of the duration.
But if I could come back to you there, Bob, I think the key Bagehot concept of lender of last resort is increasing the supply of high-powered money if there's an increase in the demand for high-powered money as such during the crisis. There's no concept there of stabilizing the price of credit instruments or stabilizing the price of bonds.
I I guess there's a sense of stabilizing the price of bills. So bills would have been the modal financing means of the day for private enterprise. So if we fast forward to these days, at least in the United States, the modal financing instrument for corporations, the ones that do the investment and hire the workers, that the modal instrument for their financing is the corporate bond. So I think you're right. Badgett would have been surprised at the idea of stabilizing bond prices, but he would also have been surprised at the way companies finance themselves, I think.
I have a, Gilfie, I drowned in the data, forgive me. And I have a concern and a suggestion. What would happen if you reduce the number of countries? You get rid of let's call it the less important countries. The smaller countries, you can define less important.
But you keep talking about Iceland.
No,
You want to keep Iceland in.
we know
everyone
that's very.
stays in.
But the other concern I had is whether the principal factor one was really the mirror image of the principal factor two. So it goes back to my question in my presentation: does the capital account drive the current account or the reverse?
Yeah. Right. So, well, the first principal component that captured the inflow countries that developed current account deficits before 2008 that were subsequently reversed. So that's the problem countries that we talk about. But the surplus countries seem to be more persistent, so that Germany is a surplus country. It continued to be a surplus country after 2008. It didn't lend to Iceland after 2008, or Ireland maybe, but so the surplus countries like Germany, Netherlands, Sweden, Denmark, Norway, they remained surplus countries. So their surpluses were then invested somewhere else. So the first component captures what happened to the deficit countries in the crisis. The second component is this identification of chronic surplus countries and deficit countries. So there are two variables. So the surpluses of Germany did not mirror the deficits of some of these problem countries. Germany maintained surpluses even after 2008. Well, yes, Iceland deficits disappeared overnight, more or less. Yeah, but the idea is to have many countries, because it's what's interesting is you can just construct 2 or 3 variables that capture all the information in this huge matrix. That's the idea.
So in some sense, if we think of Germany, Germany has a persistent surplus country.
Yeah.
But can we break that down into what I would call secular persistence and cyclical? That is, there's significant variations within Germany in its current account surplus?
Yeah, so it increased up to 2004, as I remember. 2004 was increasing, but it it's remained high. So there was a pattern where the surpluses increased in the early 2000s and then stayed high, did not vanish. Yeah. Yeah, right. So, but I would like to go further back, but then one has to have a much smaller sample of countries. So we could throw out some of these countries. We would have to throw out Eastern Europe, and have like the G7 going back to the 70s. That could be interesting. But then you're only with 7 countries, but maybe that can be summarized with 1 or 2 components also. Yeah, right.
To follow up with Gylfi, if I may, you gave a causal interpretation. You said that there was evidence in what you've found that the net capital flows are
Yeah.
sort of autonomous, and the current accounts are the result. I guess I think of factor analysis as purely associational, purely kind of grouping the correlations. And so I wonder how you get to the causal interpretation out with this technique.
Well, it is just statistics, but
Is
when you
that
look
to
at,
me or to Gylfi?
That was to Gylfi.
Oh, sorry.
so that, yeah, it's a good point. Yeah, I admit it was a stretch, but I mean, I guess once you've done the analysis, you try to understand the components, if they have any meaning. And in this case, the first 2, even 3 components, you could sort of define what they represent. But the stretch to having a causal interpretation could be justified by, if it was just idiosyncratic local factors that made some countries have deficits, others have surpluses. If it was just domestic conditions that created current account deficits or surpluses that then generated capital account surpluses and deficits, I thought we might not see the same pattern, that one component could explain almost half of the variation in this big matrix, that there had to be some culprit that was causing them to behave at the same time. I mean, why would the current account in Iceland and the Baltics and all these other countries evolve at the same time? They would all go down into deficits. And then in 2008, all jump in, well, in the floating rate countries jump into surpluses and then take some time to go into surpluses in the rest. That there had to be a common cause of this. But it's a stretch. I mean, the factor analysis doesn't prove anything. It just gives you the data, and then you can talk about it and try to understand it. But yeah. So if the same thing happens to many countries at the same time, that I thought you could say there's some common element that is causing these patterns that so many countries share at the same time. So it.
And I look,
So
sorry.
it's like when you're here in this country, people talk about Iceland as being the center of the world, even though, it's the center of some people's world. And you think, what went wrong in 2004 to 8? And you blame it on the bankers, you blame it on the central bank, you blame it on, and you think this is the only country that where this happened. And then you go to Ireland and they tell the same story. They blame it on the bankers, they blame it on the central bank and the supervisory and so forth. And you go to the Baltics, it's do the same. But if the pattern is the same across these countries, then probably there was an outside source that affected all of them at the same time. And that source could be, it's not proven, it could be the capital flows. It could also be that they just all failed at in the same way. So failure of policy in all countries at the same time. But I think it's yes, it doesn't prove anything, but I think it's a fair interpretation that that there's a common cause.
I
So
like,
If
I
it
like,
wasn't, so just one thing, if it was the current account that was controlling the capital account, then you would have 46 countries, each with their domestic monetary and fiscal policies and whatever. And some would have surpluses and others deficits. Some would be borrowing, others lending. But I thought I would not see the same pattern. Yeah, that was what I was thinking when I talked about it as a causal one, but it's a stretch, I admit.
Maybe technically what I'm asking for is that you elaborate your null hypothesis so that we have a clear, you're expressing sort of a sense of surprise that you get such a high percentage of the variation accounted for by the first two factors, but it seems like that frequently happens with factor analysis. But in any case,
if there's a common component affecting everyone, then that's what happens. Yes.
Bob, I interrupted. I'm sorry.
no. I want to make, I want to focus on what I would call the 2000 decade. So in my view of life, every decade is sort of different. But what makes the 2000 decade different is that you can't blame it on the United States in the sense that the US had an increase in its capital account surplus, just as Iceland. When I'm in Iceland or in Ireland, they blame it on the United States, but the United States was a victim. So where were the surplus countries? In my view, surpluses drive the deficits. And where were the surpluses in the 2000 decade? Why did virtually every European country have a major house price boom? Some of these countries experienced a crisis after the boom, and some, Germany, France, did not experience a crisis. So the causal, in my view, the causal factor in that decade is China and the oil price. So China has an increasingly large capital account deficit, and the oil price countries, remember the oil price surge, the surpluses of the oil exporting countries surged, and they had to be offsetting capital account surpluses if the reserves of the China and the oil exporting countries were to increase. That differs from what happened in the 1990s decade, where it was the rest of the world against the United States in some sense. And the US capital account surplus increases as the capital account deficits, this is now the end of the 90s, as the capital account deficits of the Asian countries declines.
Although I would add to that, Bob, you have to look at the pattern of surpluses and deficits within Europe. So Germany, big surplus, Spain, deficit. So there was part of that process within the monetary union.
Well, that's right, but we have a monetary union called the United States of America. And so you wonder, why was the deficit in, why were the countries that had, why were the states that had crises, why were there 8 or 10 states that had crises, and why did 40 states not have crises? So if you're going to have a surge in the supply of credit, it's going to go to the groups that are most willing to borrow. And when the spike in the supply of credit eases, or when you come on the downside, the countries or the states that have borrowed most significantly on the upside of the spike, where are you going to have the crises? It's a little different in the United States because the banks operate nationwide, but the crises occur in Florida, Nevada, or pardon me, California, and a few other states.
But can I ask you, Bob, the role of the bond market in the Euro system, where didn't the price of bonds, the price of government bonds went up in the inflow countries, so that a yield on Spanish and Greek and Italian debt was very low, and then it suddenly jumped, so the bond prices fell in 2010-11. Could bond prices be playing the same role as exchange rates and in the floating rate in your story that clearly bond prices were high and then collapsed in 2010-11, just like the currencies in the floating countries. Have you thought about that?
Bob McCauley or Bob Halliburton.
Bob Oliver.
Try the question once again. I thought you were aiming it at Bob McCauley. Go ahead.
No, I mean in the floating flexible exchange rate countries, the capital inflow causes the appreciation that generates the current account deficits. And
May I interrupt you there?
yeah,
Yes, the capital inflow leads to an increase in the current account deficits, but the capital inflow also leads to a spike in asset prices.
yes, I know. You're right.
So if I think of the Icelandic, the adjustment within Iceland, I would say 90, I'll make up a number for the orders of magnitude, that 90% of the increase of Iceland's current account deficit was due to the increase in asset prices, and 10% was due to the increase in the price of the krona. Now that's going to differ across countries. It will differ across time. But what explains the crises is that when the capital inflows slacken, there's no reason to have such very high asset prices, and they tumble.
But in the Euro system, the bond prices changed instead of exchange rates. So there was a bond market boom and bust, wasn't it? So did that play any role in this, in your story, that you could adopt the story to the Euro through the bond market?
Oh, I love the way you're pushing on what I would call the texture. So what is happening in Iceland and in Ireland, and I'm guessing in Spain, is that it's not so much the increase in the price of the existing supply of bonds, but it's rather an increase in the volume of bonds outstanding. In each of these cases, we had surges in real estate prices. That meant we had to have surges in the supply of credit, of mortgage credit. So this leads to this distinction. When is the adjustment in the form of an increase in the supply of bonds, and when is it in the form of an increase in the price of bonds or other securities?
Yeah.
If I could add something here, Gylfi, I mean, my thought would be that in all of these cases, for banks themselves become a key focus of the asset inflation process, so that the valuation of equity and risky bonds in the banking system become totally distorted by the monetary inflation which is underway and contributes to these patterns of excess credit and lending and everything else we see. So you really fall back on a common monetary explanation for all of them.
Right. can I ask two questions?
Please.
So for Bob Macaulay, what do you think about this idea of Martin Wolf's a few days ago that when the US has used the position of the dollar as a reserve currency to cause damage to Russia by freezing the reserves, that will contribute to the disintegration of the, I guess, the world payment system, so that the dollar will no longer be as powerful as before. That I think I understood him that way. So that weaponizing the dollar will have consequences in future years. So countries like China will be afraid of keeping the dollar reserves in so that was one question. Then for Brendan, how would central bank electronic money, this idea that a central bank should issue electronic money, affect the stability of money demand and the anchoring problem that he was talking about? And maybe Bob Macaulay in the end, why did Iceland not get a currency swap in 2008? The only country left out, left on its own. All the Nordics got it. There was one exception. Yeah. So that's the 2.5 questions.
Can I
Right,
intervene? Can I speak to the first question before Bob
Please.
Macaulay does? Russia has a current account surplus.
Yep.
What the actions of the US government have done is to have essentially blocked Russia's access to its holdings of dollar securities, because it cannot sell those securities to finance the purchase of something else. So in that sense, these measures may have some impact in the long run, but they're not going to affect economic activity in Russia in the short run. The instrumental variable in the short run in Russia is its exports of oil. And as long as the world oil market is in excess demand, Russia is in heaven and could brush off its existing holdings of international, US dollar securities. Sorry, Bob Macaulay.
No, I wish to agree that the sanctions so far in terms of the real trade flows have been more negative for Russia's imports than negative for its exports. And it starts off with an export surplus. And so the blocking of a stock has consequences, but it doesn't seem like one of the consequences will be to make it impossible for Russia to finance imports. The constraints on the imports are elsewhere. But I think you mischaracterize what has gone on. It's not just the US that has blocked Russia's access to dollar reserves. The US has joined with its allies, and most importantly, the Europeans, but also the Japanese and the British, in blocking the Russian access to everything but its gold and its RMB reserves. And both of those have different problems, by the way, but the key thing for the dollar's prospect as the global #1 currency is this cooperation among the allies. So the lesson, I mean, Russia clearly moved a lot of money out of the dollar, and it's two of its principal holding places seems to have been the Bundesbank and the Banque de France. So clearly, the Russians hoped that they were getting out of harm's way by moving money from US dollars into euro and into official, apparently official institutions within the euro. So if you noticed in passing what the president had ordered in terms of Afghanistan, that was quite different. That was unilateral. And as I understand the executive order, it was sort of half of the Afghani reserves in New York would be set aside for lawsuits, and such lawsuits are all already beginning against Russia, similar lawsuits, but half of it would go to sort of humanitarian aid to the Afghanis as administered by presumably the United States. So the unilateralism of that and the one-sidedness of the decision, I'm tempted to say extra legality of the decision of who would receive the benefit of half of the Afghani reserves, that seems to me to be extremely problematic. Whereas something where the US dollar is not, the US dollar reserves of Russia are not being treated uniquely, that seems much less problematic, but perhaps there's something about it I don't understand. So my point is unilateralism, and especially unilateralism as in the Iran case that goes against the continued policy of allies, that seems to me to be the more problematic weaponization of the dollar. Then you had a half a question for me, Gylfi, and you know, I suppose one answer is that Denmark and Sweden historically were in the swap network that goes way back, and Norway, I suppose, by virtue of its large holdings of U.S. securities, had an argument for inclusion that made it an argument for addition. But I mean, the point I made that if you look at the five central banks, that your coverage of the forward exchange market is the global forward exchange market is extremely high. That point applies. I mean, the amount extra of the forward exchange market that you pick up by adding the Central Bank of Iceland is going to be tiny.
Yeah, of course.
If I can come back to Gylfi on his question, I think you meant by electronic, you meant digital assets,
Yeah,
yes?
digital, yeah.
And of course, there's a running theme from the discussion we've just had about sanctions, because obviously a lot of wealth owners around the world in politically exposed countries will probably conclude that safer than holding dollars or euros or yen is going to be some combination of gold, and when they need to use it for transaction purposes, they'll sell gold for Bitcoin or whatever and use those for transactions. That's going to be the main alternative asset to the dollar, that combination that gets a fillip from what's happened. But in terms of the digitalization of fiat monies, I think you have to distinguish between the case where the digitalization is taking place by the central bank and digitalization where it's taking place as part of a competitive outcome.
No, I was thinking about central bank.
I think digitalization by the central banks is not really going to accomplish very much in terms of better anchors or anything else, because there's going to be understandable skepticism all around about holding central bank digital assets, what you're actually getting a safe haven for, or in the world as we know it today. I think what people want is not another money which is exposed to all the surveillance capitalism, but something which is outside that. And the real benefit in terms of anchoring would be if you got a big expansion in a stable coin market, as meaning that banks and other non-financial institutions of considerable capitalized caliber could enter that market and produce stable coins, whether in dollars or other assets. And that really would go a long way towards creating a new, strong and stable demand for high-powered money.
But wouldn't this?
I didn't understand that at all, Brendan. A stable coin strikes me that the stable coins we have are some sort of rustic money market fund, as best I can tell, commercial paper on
But I would say what I'm referring to here is if JP Morgan could issue their own stable coin, 100% backed by treasury bills and money at the Fed, and that could be held by anybody and transferred not under the surveillance systems we have, the demand for that would be huge. But of course, what we've had is as soon as JP Morgan even went out on that trajectory, they had every regulator in the world coming down and clamping down on them being able to do that. So I would say the analogy is an expansion. If we had a stable coin, digital asset, dollar asset, similar to banks in the United States in the 19th century being all able to issue their own banknotes, yes, there would be a big impact there on stability of demand for money.
I don't know what you seem to be describing as something like a government money market fund that is not subject to anti-money laundering, know your customer requirements. That seems to be where you get the traction there.
No, I would say it was much broader than that, but it's a monetary asset which can be transacted between A and B without a third party being involved in that, which has a lot of inconveniences and costs which go far beyond any question of money laundering or not.
So what are the pros and cons of central bank digital money? I mean, what's the, it's sort of, if people prefer keeping their money at the central bank rather than in commercial banks, then you're approaching some sort of a narrow banking, but I don't think that's what they want to do. Do you have a sense?
Yeah, I mean, obviously, you have to look at what this central bank money, what the nature of it is, how much it's like in China, something that is definitely everything is known about it by the surveillance authorities. And yes, there's going to be a demand for that, but I think the key requirement in terms of anchoring is there's a thriving private digital money alongside in the form of these stable coins I've been describing.
Mm-hmm.
It does seem to be,
Go ahead.
well, I want to make a distinction. The anchoring seems to me to be associated with what happens on the asset side of the central bank. And if you want, digital money involves the character of its liabilities. That distinction, I think, should be clarified.
I mean, anchoring, as I explained, is the key nature of that is to provide a constraint on the growth of money supply, which cannot veer ahead or veer below demand for money. So the key requirement there is that one is able to, that within the monetary system, there is a stable and strong and broad demand for this base money asset.
Catherine, you're muted.
Yeah, there we go. So I think at this point, unfortunately, I hate to cut off discussion, but we're at the end of our time. So I want to thank all of our presenters. This was a great presentation. Covered a lot of different areas. We, as you noticed, have been recording, and so we'll be posting all this out on YouTube, and we'll make links available to everyone, and be freely available, not just to our conference attendees, but also to anyone out there who's a member. So I think this is really great. Actually ties in nicely with our speaker yesterday, some of the discussion there. And I just want to thank everyone.
Well, we want to thank you for
Thank you very much.
having such a marvelous open tent.
You're welcome. You're welcome. You're always welcome.
Thank you.
very much.
Thank you very much.
I'm going to stop
Bye-bye.
recording. Okay.